and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host, and things these days are moving way too fast. We got so accustomed for 4 years of very slow, sedate trading. Global events progressed slowly, and now they're moving way too fast for a weekly podcast. But we're going to try to catch up on some of these topics today, and we'll probably have to leave some of them for next week. But before we get started, let me make sure to thank our sponsors. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies, perfect for diversifying your equity and bond portfolios previously only available to big institutions on the ultra-rich. Check out their website at simplify.us. That's simplify.us, and you can find their entire lineup of ETFs at simplify.us/ETFs. Okay, big breath. Because I rarely have guests on this podcast, the process of putting together this podcast, which has roughly a weekly cadence, but the process is different than it would be if I had guests every week. With guests, you kind of know when you're recording because you have to schedule with them when you're going to record, and you're getting content that typically will have some shelf life because you're signing them up 6 weeks in advance, and you don't know what's going to be happening in 6 weeks, but you have to give some idea of what it is you're going to be talking about. And so while you may talk about the topics of the day, you're generally trying to talk about things that will give the podcast some sort of staying power. So you're not focusing just on news of the day. Now, when I do a podcast on, how tips work or, where does gold fit in an investment portfolio or something like that, now that has a long shelf life. And there's no really important schedule to that. But I also want to talk about current topics some because inflation, particularly over the last couple of years, has become a current topic. And that's what you listeners are thinking about is, how inflation, the news of the day and what does that tell us about inflation? What are we learning about inflation? What should we know about inflation? And what should we worry about? And so I want to talk about those current topics. Those podcasts naturally tend to have a shorter shelf life, but potentially more immediate relevance. So the classic example here on this podcast is my monthly CPI reports. My monthly CPI reports get the most hits of any of my podcasts, by far the most near-term plays because they come out the day of the CPI. And, so people who want to know about last month's CPI, for a couple of days, couple of weeks are interested. But then after another CPI comes out, that podcast will almost never be played again because they're kind of irrelevant. We have more current information. The other problem, I guess it's not necessarily a problem, but the other circumstance that with talking about current topics is that sometimes the volume of topics just sort of overwhelms the calendar. So when you've got, a list of things, how does velocity work? What's the current, how do tips work? Things like that. You've got a list of those things and it's, pretty easy. There's no real calendar to those things. But when you talk about current topics, well, it's whatever happened in the last week or 2 weeks or whatever. And sometimes the volume of topics sort of overwhelms the calendar. I only do a podcast at most weekly. But when news stories are popping up every day or every hour, it can actually delay the pod a little bit. And that's kind of what's happened this last week because I keep having to append stuff that I don't want to have wait until the next podcast, right? So the pod, when the pod finally comes out, what kind of releases it is the fact that the first stuff that I put on the rundown is starting to get stale. And so I need to get it out there or it was just sort of a waste. And so that's kind of what determines the cadence. It's a really weird thing. But for example, my first topic today, and again, I've got a whole list of topics. I'm going to cover as many of them as I sort of can in a reasonable amount of time, and I'll leave the rest of them and maybe to next week. But my first topic today was going to be, or is, is the DOGE dividend inflationary? So, but this was a topic about more than a week ago or more, and it isn't something we've heard about in the last couple of days, but I think it's an important topic. There was a discussion about what to do if DOGE, DOGE being the committee, or not really a department, but I guess the advisory group led by Elon Musk, that's supposed to ferret out waste, fraud, and abuse in the federal budget. And the question, there was this discussion that was like, well, okay, DOGE says they found $100 billion, and let's suppose they find $100 billion in waste, fraud, and abuse. And of course, there's the question of whether or not is that $100 billion a year, or is that $100 billion one time, and so on. But let's leave that aside. But the question was, okay, you found $100 billion. Now, what do you do with that $100 billion? Do you pay down the debt with that? Because you have already earmarked, that spending, and or do you return it to the taxpayers that, have paid us too much, or do you save it and then just apply it to next year so that next year's taxes can be lower, or next year's spending can be higher, which of course is what Congress would love, is let's take the savings, apply it to next year, and spend more by using that, which of course defeats the whole purpose. But one of the ideas was, and I don't know where it came from in the administration. It sounds like it was something that Elon and Donald were, joking about over coffee. And Elon said, well, hey, wait, maybe that should be a plan. But somebody mooted the idea of sending, 5% of that in a DOGE dividend, just because the idea being, look, we're saving actual money. This is not hypothetical money. It's real money, and it's your money that you sent. So therefore, here's actual money that you're going to get back, and send it as a DOGE dividend back to taxpayers in equal checks, not proportional to taxes paid, or else a lot of people wouldn't get a check, and a couple people would get a really, really big check. But something much more like the COVID checks that went out, that were kind of an equal for everybody, more if you had a couple kids, whatever, but more or less, it didn't matter what you'd paid in, but everybody got a check. And weirdly, when people started talking about this DOGE dividend, one of the biggest pushbacks was this would be inflationary. And there were articles written about how it would be inflationary to pay a DOGE dividend. Because remember, the last time we had a big drop of checks into taxpayer accounts, inflation went up. I am reminded, and I was reminded when this all happened, of the way you can train a hamster to push the little green button and never the red button to get food. You make it so every time the hamster pushes the red button, nothing happens, pushes the green button, food comes out, and pretty soon the hamster realizes that if he pushes the green button, it gets food out. And the hamster knows that is a kind of a cause and effect. Now, the hamster has no idea why he's getting the food. It's purely a Pavlovian response. And that's what's happening here. The hamsters in the cheap seats say, well, the last time we sent checks, there was inflation. Therefore, the next time we send checks, we will get inflation. But those hamsters don't understand why there was inflation last time, which, by the way, is its own problem, the terrible economic education in this country, because these two things are not alike. These checks are not alike, not like the COVID checks. Those hamsters don't remember that there have been checks in the past, prior to these checks. George Bush sent around checks that did not result in inflation because they're hamsters and they have the memory of hamsters, and so they have a very limited ability to extrapolate from recent events without really understanding why it is and what the causality is. So is a DOGE dividend inflationary? Because the last checks were in fact inflationary. So what we're talking about here is an amount of money, $5 billion, $10 billion, whatever, the government sends back to individuals instead of the government spending it. So the government was going to spend it on, Taco Tuesdays for the EPA. And DOGE says, that's kind of dumb. We don't really need to have Taco Tuesdays for the EPA with the taxpayer money. And so That's $10 billion. Let's send it back to the taxpayers, the people who sent it in originally. How in the world can that be inflationary? How can not spending it on Taco Tuesday be inflationary? Right? So we were going to spend $10 billion on Taco Tuesday. Instead, we're sending it to people who maybe they buy tacos with it, maybe they don't, but they certainly aren't going to spend more than $10 billion, and it was going to be spent. So the initial gut reaction has got to be, it's not at all clear to me why that would be at all inflationary. If you know, and if you think about it for more than 4 seconds. Well, the hamsters say, but the cash checks in COVID were, and these are cash checks, therefore they're the same. But back in COVID, that was new spending. It was vast spending, right? This was not money coming from amounts already appropriated. This was Congress saying, let's send $10 billion or $100 billion or $1 trillion. Let's send that out the door brand new, and we're just going to have to borrow it. And even then, if they had simply done that, if they issued $1 trillion in bonds and sent $1 trillion to individuals, it's not clear that that's terribly inflationary because the money to buy the bonds comes out of the system and the money that the individuals are spending goes back into the system. It's called fiscal irrelevance. And that in itself, although consumers have maybe a higher propensity to consume than a bondholder does, that's the only argument for why that might be inflationary. The problem was that then the Fed went and bought that $1 trillion worth of bonds and so effectively created the money out of nothing. So the money didn't come out of anybody's pocket. It just went back into everybody's pocket. And obviously, that's inflationary. The government printed money and sent it to people and said, this is for Taco Tuesday. And the taco trucks were all sold out because everybody rushed the taco trucks. Well, that's obviously inflationary, right? Because they were using, it was the source of the money was coming from the ether. So yes, that's creating new money. And of course it's inflationary. But what's really crazy about this topic number one here is that the people who didn't consider it all inflationary the first time around when it was being printed are the ones who are most concerned now. Remember, it was transitory. Like nobody could figure out, well, this is just temporary. It's not real inflation. It's just things are just a little messed up and it's all the prices are going to all come back down. Those are the they didn't understand it then, and now they're really concerned that it's inflationary. So really, really funny. Anyway, they, as usual, they learned a lesson, but the wrong lesson, and that's what you get for trusting hamsters. Okay, so that's topic one. On to topic two. Topic two: tariffs. Now, I'm not going to relitigate this every time. We're going to obviously talk a lot about tariffs. We've talked about tariffs a lot so far. We're going to be talking about them a lot over the next couple of years, I suspect, because tariffs are going to be a major tool for policy, both economic policy and for geopolitical policy. But it is worth so I'm not going to relitigate it every time, but it is worth a reminder that reciprocal tariffs, if everybody tariffs everybody else the same, so we go from totally free trade and suddenly everybody taxes everyone else 50%. Okay, that reduces the global pie. It does not reduce necessarily everybody's slice unless everybody has the same exports and imports. Okay, and they're all equally, equal size slices and equal exports, equal imports everywhere, equal power, equal elasticities and everything. In fact, if you do that sort of round robin circular firing squad, the piece of the dominant player most likely increases. Certainly, there's no reason it can't increase. You know, the overall pie decreases, but the dominant player can see his pie increase, and that's in fact what we're seeing these days. This is part of the whole theory behind the Trump administration's decision to no longer be the only people doing free trade. The U.S. is the dominant player, and it has a small import-export sector. So, give you an example. Just today, very topical, the U.S. reinstituted 25% tariffs on Mexico and on Canada, and only 10% on energy from Canada. And Canada responded with tariffs on about $100 billion of U.S. goods sold into Canada, our exports. And it's a good test case because Canada is one of our largest trading partners, might be a state at some point. But in 2024, so just last year, the U.S. exported about $350 billion in goods to Canada and imported $413 billion from Canada, so had a trade deficit, of which about $130 billion of what we imported from Canada was energy. We actually also exported energy goods to Canada as well. But so basically, what's that? 283 billion of goods and then $130 billion of energy goods. So if there's no price response to the 25% tariffs, so what's the effect here? So we're importing $413 billion from Canada, of which 130 is energy, and 283 of that goes up 25% in price. And the energy goes up 10% on that 130 billion, and there's no price response. We buy just as much stuff as before. Then our costs in the economy go up about 71 billion plus 13 billion, or about 84 billion in an economy of 30 trillion. So inflation rises about 28 basis points one time. So that's 84 divided by 30. And so 0.28% one time is the effect that you have on the overall inflation, although obviously you'd have more inflation on the goods that were specifically tariffed. Now, just as an aside, just for fun, we should keep in mind that since our national debt's about 37 trillion, that 0.28% rise in the price level means that the real burden of our national debt goes down by $103 billion. So it's not clear that's a loss at all. In fact, the taxpayers actually made quite a bit of money on that deal. Our costs of goods we purchased went up 84 billion, and we saved 103 billion on debt. So anyway, but ignoring that, so let's forget about the debt effect for a second. 0.28% one time, but of course that's not even remotely close to the actual effect, right? Because in my quarterly inflation outlook, and there's a link to buy it in the show notes. Actually, every week there's a link to buy it in the show notes. But in my quarterly, I use some hypothetical numbers for export and import elasticities, price elasticities of demand and supply, and so you get, just as a rough guess, to an incidence of 23%, meaning the consumer pays about a quarter of on average of the effect of the tariff. Okay, so now there's all kinds of crazy error bars around that, but it's not a bad guess that of the amount of the example on the other border, avocados from Mexico are going to become much more expensive now, 25% more expensive. And Chipotle came out today and said, doesn't matter, we're not changing our prices at all. Okay. Chipotle sells a very elastic, there's quite a bit of elastic demand for Chipotle. And so as a consequence, they have to bear, the supplier there, Chipotle, has to bear the cost of that tariff, not the consumer. Okay. So anyway, that's what happens, is that the supplier is going to bear the cost of some of this. So let's just suppose it's 23%, which is what I came up with. That means that 28 basis points we already calculated goes down to about 6 basis points. So tariffs on 25% of everything from Canada and 10% from energy means the price level goes up one time 0.06%. Okay, which is negligible. And that's if tariffs are on 25% on everything. There's no change in the volume of cross-border transactions, which of course there would be, and it's a one-time effect on price. Now, as I said, it reduces the pie, and in the response of Canada would cause exports to Canada to decline. the on the other hand, because the response of Canada, meaning the tariffs that they put on our stuff, will cause export to Canada to decline. On the other hand, domestic U.S. producers would see greater domestic demand because consumers would seek to buy from cheaper U.S. sources. The same thing, of course, happens in Canada, except Canada doesn't have the depth of manufacturing and all the different sorts of goods that the U.S. sends it that the U.S. does. So the U.S. would have an easier time replacing the goods that Canada sends us. Not all of them. We only have so much capacity to produce maple syrup, but many of those goods, energy, for example, right? So we have lots and lots and lots and lots of energy in this country. It's not all in the right places, like where the Canadian crude comes in is not where we kind of have the pipelines going from other parts of the country, but the energy is available, right? So we can replace that stuff, and it's a little harder the other way around. But anyway, the net effect on growth in Canada is quite negative because they're selling less to us. Their exports go down, and they don't. They're not able to replace the manufacturing for what they are losing in terms of the imports. The net effect on growth in the U.S. is probably marginally negative, but it's not really large because, again, there are manufacturers in the U.S. that would replace a lot of that. And because there's a net trade deficit for the U.S., if all trade went away, then we'd be exporting less, but we would have to replace more imports than we lost in exports. So you could sort of figure out that if you have a net trade deficit, then it's more likely to be the other country's problem. Anyway, I'm not going to relitigate tariffs every time, but it's really important to keep in mind that if you're the dominant player, if you're a net export or net importer, and especially if the elasticities are high, and so you're talking about products that have a high price elasticity of demand, then it doesn't really have a very big impact on you. But it has a lot of impact if you're a small country, very dependent on exports, to a country, to a much larger country. And since the U.S. is the dominant consumer, that means we're the big fish. Okay, topic 3, which is somewhat related, recession. Okay, so now we get to where everybody is panicking over a recession. And it's partly because the GDP trackers, the Atlanta Fed GDP tracker, for example, they're all deeply negative for Q1. Okay, so they're all saying we're going to have negative growth in Q1. And that happened because of the explosion in the trade deficit in the most recent figures. GDP is C plus I plus G plus X minus M. So it's domestic consumption, investment, government spending, and net exports, plus exports minus imports. Okay, so we had this huge surge in imports, and so that's the minus M, and so GDP declines. But that explosion in the trade deficit, that explosion in imports, was a lot of it actually was gold, and the rest, much of the rest of it was other goods front-running tariffs that everyone knew were coming. And so everybody rushed to import as much as they could before the tariffs went into effect. Massive effect in January, but it's not going to keep happening. And so, in fact, over time, imports should fall a lot. So this is probably the sort of thing which is Q1 is a negative effect and Q2 is a positive effect, right? So you get a rebound. Since COVID, so are we going to get a recession? So you'll get a negative quarter probably. You'll have to see what February and March brings, but are we going to actually have a recession? Well, this is a tough question, and I've dealt with this on this program a bunch because I've been thinking for a long time we'd have a recession. And what has really, I think, happened is that since COVID, we've had this weird asynchronous thing going on with the economy where we've all been looking for a recession, and it's always going to happen in next quarter, next year, and it never actually shows up because we've gotten lots of mini recessions in different areas. So in like 2021, we had a boom in goods and a bust in services. if you were in a service industry and, when we were all locked down, you probably felt like you were in a deep recession, and you were. But if you were manufacturing, you probably didn't feel like that at all, because there were, people wanted to buy your stuff with all their extra cash. And then the echoes of that sort of reversed, rather than being synchronized like they usually are. So, and this has been going on in lots of little ways. Last year, the unemployment rate did rise well off the bottom, and that almost always presages a much larger increase in the unemployment rate. But it hasn't really happened yet, although partly it's because something like 25% of new jobs last year were government jobs instead of the usual 5% or so. And this year, we're going to have government layoffs, so we're going to have the unemployment rate rising, but probably an increase in output because those people we're laying off will have to get productive jobs. So that's weird. And then we'll have the tariff effects, a short-term surge in imports, followed by a crash in imports and a replacement of those imports from domestic sources. So what is this? Is this a recession? Is it an expansion? We had credit defaults went up last year, and that looked kind of like a recession. I think, obviously, part of what happened was, COVID was a giant rock being thrown in the pool, and we're still feeling the ripples, and the reverberations from that, and we're going to feel those for quite some time. But I think also the U.S. economy has gotten to be so diverse and large that recessions are harder. And what do I mean by that? Well, if you look at the global economy and you say, well, what's a recession in a global context? It's not 2 quarters of contraction, because that just doesn't happen in a global context. Since 1950, we've only had global growth to be negative on a real output per capita basis 5 times. 1975, during the energy crisis, 1982, 1991, 2009, global financial crisis, and 2020. Okay, so all those were calamities. And so unless you have a calamity, you just don't get global growth to go down. And so if you have global growth of 1%, that's considered a recession. And the U.S. economy is getting to be like that. It's getting to be so large. There's so many different producers producing so many different things which move at different cadences and different rhythms that it's kind of hard to have a real 2-quarter traditional recession like we would have back when we were predominantly a manufacturing economy, and all of the manufacturing was all kind of linked together. So it's much harder to have that. Although if we really do slash government spending a ton, then that's the G, and you're going to have GDP decline because the government isn't spending the money. But then taxpayers will have more money, or people who would have bought bonds will have more money, and so they will spend, and so the C will come up. So, but between the tariff thing and the government spending thing, we could well get negative quarters, negative growth. But I think it's going to be really hard to have sort of an extended recession in the U.S. A global recession, if in fact tariffs kind of go up globally, you can get that. But it's going to be really hard to have a significant U.S. recession here. Now, fortunately for us on this podcast, as we care about inflation, we don't really care all that much about recession because inflation is not related to growth and disinflation is not related to recession. Okay, I'm already up to 29 minutes. I'm going to get one more topic and then I'm just going to have to leave the rest. Okay, topic 4 is event volatility versus implied volatility. So what's amazing to me, all that we've been talking about today, all that we talk about every week, is how many crazy events are going on in lots of different ways, lots of different direction. And yet, if you look at volatility for options in the marketplace, implied volatilities, they're quite low, and that's just really crazy. So the VIX, which measures volatility for equities, is finally moving higher because stocks have been headed down. But part of that is because the VIX always jumps when stocks move lower, and part of that is a quantitative effect because you're moving to lower strikes, and so you're moving down the skew. Not to be too technical, puts implied volatility for out-of-the-money puts on equities are always lower than the implied volatility on out-of-the-money calls. So whenever the market goes down, the VIX, which looks at a collection of volatilities around the current price, is moving up the skew. And so the VIX just naturally tends to rise in sell-offs. It's not necessarily panic, although panic can also add to the VIX, but there's a sort of a systematic. But it hasn't risen a whole heck of a lot yet. It's the oil VIX is around 30. It never gets much lower than 25. MOVE, which is the volatility index for fixed income, it's around 100. It's been as low as 80, but that's about the lowest since the cheapest to deliver switched, and so the duration of the bond contract extended. So the MOVE has been, bond volatility has been declining. A little hard to tell with MOVE because of that cheapest to deliver switch thing. But the bottom line is that all of these are much closer to the lows than to the highs. And I've seen this in the past when you have a lot of cross currents and yet markets won't be moving a lot because they're confused. It's like a big tug of war where you have, a beefy guy on one side and a beefy guy on the other side, and they're both pulling massive cross currents, but the rope isn't moving very much because they're offsetting. At some point, the rope starts to move, and that's when the market starts to move a whole lot. Okay, but the fact that the market isn't moving a whole lot shouldn't mean that implied just because realized volatility is low doesn't mean implied volatility can't be low, but it tends to be because delta hedgers who are not making money, hedging market moves tend to not really want to be buying options. And so implied vol does tend to track with realized vol to some extent. But when you get these situations, when you kind of look and there's just a bunch of offsetting, a lot of uncertainty around, but volatilities are low, historically, and this is anecdotal, just from my history. Remember, I've been an options trader, been an investor for a very, very long time. My experience has been, and this is not a trading recommendation, my experience has been that is usually a good time to be adding options to a portfolio. Instead of buying stocks, you buy out of the money options, or you protect your portfolio with puts. Doesn't mean it's a winner. It doesn't mean that those will necessarily make you money or cause you to lose less money. It just means it's a better bet. And a lot of times these circumstances where there's a lot of cross currents resolve in everything becoming placid, but not usually. Usually they resolve in one way or another pretty hard. Either stocks now will drop 20% all of a sudden in a short period of time, or they'll turn around and leap back to new highs all of a sudden. Energy prices will either suddenly plunge to 40 or go back up to 80. And the volatility being low gives you a good opportunity to sort of to play those convex outcomes. Oh my goodness, 33 minutes, and we only covered 4 topics, and we have many more topics to cover. And I'm so sorry about this. I will we'll pick up some more next week. I want to talk about pharmaceutical inflation in most favored nation policies, which is a big bee in Trump's bonnet. I also want to deal with the question of what if the gold in Fort Knox is not there? DOGE is going to go and audit Fort Knox and see if the gold is there. Well, what if it's not there? Or what if more is there than we thought? And what happens if the government wants to reprice the gold from its historical costs on the books? What does that mean? So we'll talk about that next week. But in the meantime, please like this podcast, subscribe, refer other people, contact me, Inflation Guy at enduringinvestments.com. The blog is at inflationguy.blog. And most importantly, though, while you're waiting till next week, defend your money. And if inflation is coming for you, remember, you know a guy.